We are discussing a property that is brand new construction and located roughly 5 miles from $4.7 billion in downtown Jacksonville development with $1 billion.
Oh my goodness.
We are officially live on Facebook group for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Income Property of the Week. I'm your host, Pablo Gonzalez. With me, as always, the man with great socks that I like to call GC because he's got genius concepts. He knows how to generate cash flow. He's a great co-host, and his name's Gregg Cohen.
Hey, what do you know?
Hello, Greg.
What do you know? Hello, everybody. Great to be with you. GC, great calcetines.
Calcetines. Good calcetines.
For Bill Shields out there.
You know, we in Venezuela, we don't use the term calcetines. That's like a Spain thing. Man. But I know what calcetines means. Okay. And I know if Miguel Angel Sanu is with us, he knows a good calcetin too. Anyways, we also got, she's back, our community manager, Madison the Magnificent. Say hello, Madison.
Hello, everybody.
And we are pumped to get the whole gang back together here in studio, just us. If you're listening on the podcast, you're watching on YouTube, we just tried to go live on YouTube. So let us know what you think of how stupid we looked going live on YouTube. I would love to have that feedback. And, maybe next time, instead of making us look stupid, you go to nyais.com. You join us a little early. You're part of the shenanigans. You see Gregg's socks and other insights into the show. And you get to be part of the roll call. You ready for the roll call?
Born ready.
Let's go. Lee Bishop checks in, MVP of the Not Your Average Investor Show community. He says hello, everyone. Madison is in the chat, welcoming everybody. She's our community manager. We got the ringmaster of the Not Your Average Investor Show community, Drew Barnhill, saying good afternoon, all. We got Dean Curry in the house. He says Madison is back. Yes, she is. We got the fairy godmother of the Not Your Average Investor Show community, Jen Filson. She says, hey, JWB family, greetings from beautiful Monterey, California. We got Leo Faraganan.
Dun, dun, dun,
Faraganan.
dun, 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 dun.
He says, good morning, all. Let's go rock this show. Hair bands, Leo, love it. We got Marilyn Cotterman from Homosassa, Florida.
That's the home of the manatees.
Not a new name, but a very welcome name.
That's the opposite of a new name.
She is one of the originals. She says, this is the stuff you get when you sign in early. Talking to the sock scenario. We got Bill Shields saying, aloha, Bill Shields, you're really testing me dropping the Hawaiian. We need Zach Correa to help us out there. But I thought I did. What do I get on a test there?
You crushed that. I thought he was talking about HOAs.
We got John Henning saying good afternoon, all. John, you got beat to the punch today, buddy. But
the leadoff hitter.
Our leadoff hitter, John Henning. I believe today he was batting cleanup. I like it. We got Jag Chatta checking in. Jag, we were just talking about you. He says, good morning. We got everybody. Noah Randari. He says, hello, everyone. Noah, good to have you back in here. We got Wendy Herbst. I'm Wendy. New and totally wondering who are these guys? Yeah, yes. Wendy, welcome to the show.
New name alert. So happy to have you here, Wendy.
Wendy, if we came on a little too strong and are scaring you away, just wait, it gets worse. All right, here we go. Now, but to do our best to keep you here, it's our favorite segment, which is Madison Shares Good News.
Woohoo.
What's the good news, Madison?
Okay, so good news today. We have some clients put some more houses under contract, which we love for you guys. Shout out to Stephen H., who put his third property under contract.
Wow, there we go.
Let's go.
Brian R. put his second property under contract.
Hey, yo.
And the Rileys put their fifth. And they are actually supposed to close on their fifth tomorrow. So fingers crossed that happens.
Let's go.
Rosalind, right?
Yep.
Yes.
The returning Rosalind Riley.
The returning Rosalind, the regular.
The regular.
Yes.
The returning Rosalind Riley. Yes.
Yes. So that is the good news.
Guess who else closed on?
I know.
I let him share his own good news.
Thank you, Madison. Yeah, I just closed on my third, right?
My man, congratulations,
let's
brother.
go.
That's awesome, man.
Let's
You,
go.
Martha, man, just so happy for all of our clients that continue to build their rental property portfolio, and especially the one that I get to sit next to every Tuesday and Thursday.
Man,
there, buddy.
it has been a life-changing thing for me. So I'm really pumped to be part of it.
Currys closed on their fourth.
Let's go.
Hey, yo, the good news keeps rolling.
The good news keeps rolling. Madison, we're glad you're back. All right, GC. Well, I guess we don't have a guest investor today. We're going hard at this property of the week.
Let's do it.
All right, let's do this. Let's have a 101 property understanding session. I'm going to pin us here for everybody to see, and I'm going to magically whisk us away to a property that we should have highlighted last week.
We should have. We missed the boat
We
there.
missed the boat there, but it's 4473 Hudnall Road, Jacksonville, Florida, 32207. It's got a purchase price of $300,000. That's a new POTW record. We'll talk about that in a second. It's a 4-bedroom, 2-bathroom, 2-car garage home, leased out at $1,850 a month. And it's got a beautiful picture here, clearly a new construction home. It's got this estimated financing total conventional ROI of 12.11%. But what I really want to know is, GC, what do you like about this property?
I thought you would never ask. Well, I'm glad you did. The first thing I wanted to point out is why I chose this property. I think this is a great opportunity for us to look at this property and probably challenge your investor mindset a little bit here, right? Most people, when they are looking at an opportunity to make the investment, what's the first thing they look at, Pablo?
I would say the first thing they should look at is the IRR.
Well, not what should they look at? What do they look at?
The price?
The price, right?
Yeah.
The price. And let's assume that the price is within your budget, right? If the price is not within your budget, right? We should be looking at things that are within your budget, but let's assume that the price is within your budget. The first thing that most people look at is the price. And here we have an opportunity here with a $300,000 purchase price. That might be the highest one that we have focused on the show here, right?
It is definitely a POTW record.
It is, right?
We definitely
Yeah.
have not had a $300,000.
Sure. It's not a
on the
JWB
POTW.
record. But do you remember when we had Lewis Hudnall on the show last week? So if anybody didn't get the joke that we tried to make, Lewis Hudnall was our guest investor last week. This property, of course, is on Hudnall Road. There's why we missed it. But Lewis's property the property that we featured while Lewis was on the show had, I believe, an 11.1%, 11.2% return on investment.
That's right.
Right. You know, here we have a purchase price of $300,000, but our IRR, our return on investment, is actually 12.1%. So I'd love to hear from the audience here, from everybody who's here in the chat. What do you guys think about this? Right? This is an example where it's a higher purchase price, but it's a better return on investment, right? I'll kind of tell you what I think, right? I think of myself as a financial engineer, and I realize that money always has to be moving. Money sitting dormant in my bank account is not a good thing, especially in inflationary times, right? If you think inflation really is 10% or 15%, or if you think it's 8.6%, like the most recent consumer price index, what that means is money sitting in your bank account is earning a negative 8.6% return on investment. I don't like negative returns on investment. So I know that I always need to have money moving. If I have funds that need to be moved, then I'm trying to earn the best return on my investment, taking into account risk, in order to produce the best returns on my investment. If I do that consistently for 1 year, 5 years, 10 years, 20 years, I'm going to reach my financial goals quicker. So when I look at this property, I look at the opportunity for me to put into action, right? Call it somewhere around $100,000 of capital and earn a better return on investment, earn a 12% return on investment year over year. I get excited when I look at that, because my job here is to take the amount of money that I have and put it towards the best risk-adjusted return. I don't think everybody else feels that way, though. I would love to hear from the group, from the audience in the chat, or in questions and answers, some of the questions that you may have here. It's a great opportunity for us to get kind of down and dirty into maybe what I think, or maybe what you think, and maybe understand the differences there. I'd love to hear what you think too.
Yeah, man, this kind of reminds me of the conversation we're having this morning.
Yeah.
Right?
Yeah.
Little background, right? For you, Wendy, since you're new, right? Like, we talk about this ad nauseum, but Greg and I go running on Tuesdays, Thursday mornings. We do a 4.5 mile loop, no big deal. NBD. And a lot of the time it's, we talk about everything, right? As I'm closing on this property, I had the chance to close on the property I just closed at, which has the highest purchase price that I've bought a property with JWB thus far, right? 225,000.
Yep.
And right before I locked that in, another property came to the market, and it was $150,000, right? Similar IRRs, right? Like, I believe in the whole idea that these are widgets, right? Like this, it's all very like right in the same line. And after a little bit of deliberation, I decided on buying the bigger property, right? Buying the more expensive property, because for me, as a buy and hold long-term investor that is thinking about this as something that is going to pay for my retirement in 30 years, I wanted to get more money in the game, right? I wanted to, the way I said it today was I wanted to put a bigger chip on the table.
Right.
And that's the decision I made. Now, the decision, as I was telling Greg that I kind of went through like the 7 stages of grief with it, because I've questioned myself on it, right? Like I thought, you know, at that $150,000 price point, I could have put down 30% on it and I would have had a little bit more cash flow on a monthly basis. But at the end of the day, getting the bigger property, putting 25% in, I was getting a higher ROI based on the leverage that I was going to get on my money. So, you know, I think it's that. I think it's what you said. Do you have money to put the cash into play? Or the other option, right? This would have been, it's about a $7,000 difference of what would it have been and a little bit of extra cash flow per month. The other thing would have been $7,000 extra dollars sitting in my bank account that would have made up my rainy day fund, or maybe it would have paid for a vacation next year. But, you know, I decided to just push it in and get my money working for me and figure out how I'm going to pay for that vacation by making more money.
Right. Well, so, and I think the key thing here is we need to understand what money needs to be set aside, right? When we talk about, is this within your budget? That's not just, can you afford it today? It's, can you afford it today in addition to your rainy day fund for your own personal finances, in addition to your rainy day fund for your investment properties, you know, in addition to maybe the thoughts and goals of your family, and were you thinking about taking a vacation with that money, right? So we need to have a good understanding. And for this property, you should go about it the same way if you're thinking about purchasing this home, right? Think about what budget you really have set aside to purchase this. Make sure that you have your 3 to 6 months of rainy day fund for yourself personally. Make sure that you have 3 to 6 months of your rainy day fund for your rental property portfolio as well. Make sure you're not jumping in line of a vacation or something else that might be important for your family. Once you get to that point, then you need to think like a financial engineer, right? Then you need to be in search of, how can I produce the best risk-adjusted returns on investment for my capital, knowing that your money sitting dormant and not doing anything is the worst decision. That is the way you are guaranteed to lose. Inflation is not always 8.6% or 10% or 15%, but there's always inflation. And so if your money is just sitting dormant, not doing anything, you know, you're losing that battle. If you keep it in the bank, more often than not, you're losing that battle. So I think that's really important for people to understand. Get to that threshold. Let's take into account, work with my team, right? Work with our team to understand what is that threshold, to make sure that we're not even close to getting to that budget concern and rainy day fund concern. And after that, let's think like financial engineers, and let's put the money that we have in play and making sure that you can earn the best risk-adjusted return on investment.
Yeah, that makes sense. And, you know, for my personal situation, I think it's like right at that edge of, like, I know I have my rainy day fund, but yeah, if I lived on a fixed income, then I wouldn't have a plan to pay for the big vacation I want to take next year. But because I'm an entrepreneur and I can make more money and stuff like that, you know, I just kind of bet on myself and said, if we don't have a vacation next year, it's my fault because I'm not that good at my business, at my job, you know? So, you know, that was the give and take. And at the end of the day, I'm glad I did it, right? Like, now that I'm on the other side of it, now it's just like, all right, cool. Now I got to kick back and like get this passive wealth creation machine going for me. And I'm pumped that I got this big house in Jacksonville and, you know, whatever, right? So, all right, GC. Well, we got a question already from Lee Bishop. I want to, you know, these POTWs, bring on the questions. We're going to go deep into this sheet, but we want you kind of pitching in whatever questions you have, especially you, Wendy. If you made time for the first time here, you got some questions you want us to clear up. We go into the good, the bad, and the ugly here, right? So Lee's got a question, MVP of the community, Lee Bishop.
Of course.
He says, Greg, can you go over the rent range for this house, 1825 to 1900?
Yes, absolutely. So the way that we determine the rent amount that we use on our evaluations, which is that 1850 number, and also the way that we get to our estimated rent range is by using comparable market properties that are rented right now. And we have this wonderful ability today to do this that we didn't even have the same ability to set with such confidence, rent numbers. We didn't have the same ability 5 years ago or 10 years ago, right? Because getting strong market comparables is really difficult for the average investor. In fact, I was just talking with my cousin's boyfriend, and he might be on the show right now.
Just the dude from Denver?
Yeah.
Okay.
Yeah. Great guy. And this was one of his first questions. You know, he, first of all, met the guy, just a really genuine guy, said he was interested. I said, okay. I said, I'm going to get you a book. And so I sent him Rich Dad, Poor Dad. And he said, I want to make sure that it's a good use of your time. I would love to get on the phone with you, but I'm going to wait until I read the book so I can put all my questions together, and then we're going to talk. And one of the first questions that he asked me was like, how do I set rent rates, or how do you set rent rates? And so it's very applicable here. And the way that we do that is we now have this ability, because of the fact that we're vertically integrated and we are focused on one market and we manage 4,500 homes, that we have all of the data for all of the homes that are renting within a quarter mile, within the last 1 month or 2 months, 4-bedroom, 2-bath homes, or 3-bedroom, 2-bath homes, or whatever the number is. So it's not hard for us to set rent rates. That's how we do that. The problem is there's not just an overall database out there with data that you can rely on to be able to get that rent number. When I first started, it involved driving up and down the road and calling all the for rent signs and asking those landlords or property management companies, not only what was the rent, but how quickly did it, rent out. Now you can do a lot of that because you see homes that are listed on Zillow and Trulia on these sites. So you can be more efficient there. But I wouldn't just rely on Zillow's Z estimate for what the rent should be. It's just not accurate enough. That's a data aggregator. You need to work with a company, a provider who has real life comps, real life market comparable properties that they rented recently to be able to set that. So that's how we do that. We set that, of course, for the rent range. And even more important, it's the actual rent amount that we put on this evaluation. The reason that's important is because that's what drives your return on investment of just over 12% here.
Did you even say the word data flywheel?
No, I missed that.
What are you
Thank
doing, man? So I'm going to gush on this, right? Like, this is, as a business nerd, for if you're new here, like Wendy or anybody that hasn't, listened to me speak for more than 5 minutes, I'm not an employee for JWB, right? I'm just a super big JWB fan that also helps them with marketing. And I'm a business nerd, right? Like, I read business books. And when you read Jim Collins, who's like the foremost, thinker of business and how to grow an enduring business, he talks about in his book, Good to Great, how all these companies that made a jump from being like average of the pack to being great, way above the pack, developed this data flywheel, right? Like this flywheel that continues to inform their processes. And you just don't normally see this in a non-tech company, right? Like all new tech companies are basically going for this, right? Like Amazon has an insane data flywheel.
Absolutely.
And they're all trying to be like Bezos. And then there's like the S&P 500 that they operate at the scale. You don't normally see a local company of like under 100 employees that have been developing a data flywheel that creates this like long-term tactical advantage that allows you to make better and better decisions and builds a bigger distance between you and your competitors, which you at this point you have none, right? So like, that's what that is.
Yep.
So that's, I'm always amazed by the foresight of like four dudes in there. When you guys started doing this, you're like in your 20s,
yeah.
and to start building a business in that way, so that now 16 years later, you have this like really impressive feature that I'm trying to figure out how to implement in my business in 3 years. And I haven't even figured out how to start cracking
It's like the gift that keeps on giving, because, so many questions that we'll talk about either on our run or on the show or whatnot. And you're like, I wonder if this does this. And my first thought is, if we don't already have a report for it, I'm like, oh, let me go check that out. So I go to our data flywheel and I'm like, I run this report for this, these properties purchased over this year with this criteria of whatever question we were asking. And I'm like, that just gives me so much confidence. I'm not up here sitting up making things up. I actually have data. And I don't know of another company in our space that actually has this data for this long. Yeah. There are companies now that's much more institutionalized now, which institutional players get this data flywheel, but those institutional players haven't been investing in Jacksonville for the last 17 years. Yeah. And they don't have 2,500 properties that have been purchased.
They're buying that data, right? Like it's not their own network effect that they have reached that allows them to have proprietary data, right?
There's a whole bunch of data that people spew around in this industry of like what industry standard is. Yeah. And I don't know where they get it. A lot of it is to make themselves look better or make their assets look better. But that's what the industry generally uses, because there aren't companies like us that have been on the ground for 17 years that had that foresight to actually track and measure and continue to report on this for 17 years. And so it is one of the competitive advantages we have, not just for today, but over the next 10 years.
Cool. And then Lee also, enough gushing about the data flywheel. Lee, what he wanted to hear was if you could touch base on how rent is raised during the longevity of the, investment.
Yes, absolutely. So we sign 2 and 3 year leases. And at the core of this, the reason that we sign 2 and 3 year leases is because there's an opportunity for you to win as a client, and there's an opportunity for the resident to win, which is what we need. We want residents to stay in your home for a long time. And the longer lease that they sign, chances are the longer they're going to stay in your home. And the longer that somebody stays in your home and pays rent as a great resident, the greater the chances are that you're going to overperform on your returns on investment. So you are going to win if you get somebody to stay 5 years in your home versus if they're going to stay 3 years versus they're going to stay 1 year. And the major reason is because when your people leave, when your residents leave, that is when you have the biggest risk for turnover costs, right? How much did it cost and maintenance costs to get the home back into great rental shape? You also have a couple of months of vacancy costs, which means that it's the rent that you didn't collect while they were re-renting your home. And you also have your greatest tenant placement fees or your greatest property management fees, which, are your tenant placement fees. So you can avoid all of that if you sign longer term leases and then a focus on renewing. And that's our strategy for you and to help you win. Now, a big part of this that we don't always talk about, and why I'm so happy that Lee brought it up, is how do we incentivize people to stay long? How do we incentivize people to sign longer term leases? There has to be a reason that a resident's going to want to sign a 3-year lease versus a 2-year lease. Mm-hmm. And so here's what we do. For a resident that signs a 3-year lease, they're going to get a little bit of a rent break in the 3rd year. So first year, of course, rent is what it is. Here it's, $1,850 for this home right here. Second year, depending on the rent rate, it's going to go up between 4 to 6%. So you're going to get those rent increases, those renewals, right? We all want renewals, or we all want rent increases each year. I will tell you, even if I didn't get a rent increase, it's still a much better thing to get a longer term resident. You're still going to win because you're going to save on all those other costs. But listen, we can get rent increases. That's what the market is bearing. So we're going to do that. So you get that 4 to 6% rent increase in year 2. For year 3, if somebody commits 3 years to us, that rent's going to stay the same year 3. So there's 1 year for that resident where they are not going to see, let's call it a 4 to 6% rent increase. And that's what you're giving that resident to get a better resident who's more committed to staying longer term. And of course, 1 more year where they're signed up for it. If somebody signs a 2-year lease, their rent is set, let's call it at $1,850 here today for this property. And then next year, the rent goes up 4 to 6%. And then they would have the opportunity to renew. And when they renew, it is at market rent for that year. So there is a strong incentive for that resident to stay for the 3rd year. And more importantly, the investor wins long-term because you win with longer term resident stays, and it is so worth it to give up 1 year of potential rent increases.
Great question by Lee. Great explanation by GC.
Thank you, buddy.
Just to beat this question to the punch, what about renewals? How do you guys do on renewals?
Man, renewals are probably one of the most overlooked things from a property management company. I don't know any other property management companies that treat it like a sales opportunity, that measure it, that have goals related to it, that train to it, that have pipelines, just like you would manage a sales pipeline. Our property management team has all of that when it comes to renewals. Communications in place many months in advance. And because of all of that, our property management team is absolutely crushing it for renewals. We re-sign over 70% of our residents that come up for renewal, 70% of the time. And these aren't people that signed a 1-year lease right off the bat. These are people that committed to being with us for 2 years or 3 years right off the bat. And so over 70%. And that number has continued to go up. If you were a client 4 years ago or 5 years ago, we talked about how our percentage was 60% and then 65%. And as many of you know on the show here, I'm pretty slow to ramp up our percentages, right? Like for example, home price appreciation last year in Jacksonville was 20%. On our evaluation here, you're going to see 4.6%. right? I'm not going to take the latest and greatest. But this is a sign and just a wonderful example of our team understanding how important this is for you as an owner of rental properties, and hiring the best talent and building the best systems and having the best goals and measurement all in place so that we can continue to raise that standard. I don't know how much higher we can go. I'm a little scared to go even higher, but right now I know that we're performing over 70% for this year. And I feel really good about that being what you would expect for the resident who, eventually rents this property too.
If I was to distill everything that you just said and make it simple for somebody that hasn't heard this 45 times and has really internalized it, I think the key takeaway is that when you are investing in a turnkey rental property operation, your success, right? The maintaining of the ROI that was promised to you is going to hinge on an occupied property.
Yes.
And that means that the property management company that is handling it, whether they are vertically integrated like you are, that's selling them, and you are also the company itself, or somebody else that you're hiring, should be figuring out ways to keep residents in the house as long as possible. And what JWB champions, which is what they think others should also do, wherever you're investing, is long-term leases, right? Like your property management company should be telling you how they're trying to, if they're telling you that, no, man, 1-year lease is the best thing because we just want to get them in and then you can raise the rent. That's not a good answer. You want them trying to get long-term leases, even though it's harder for them because it's better for you. And they should know what their renewal rate is of the people that are sticking around.
Absolutely.
Right, cool. So
that is a great question to ask. You're going to stump a lot of property management companies.
Yeah. So whomever you're doing business with, ask them what you're doing to ensure that you get longer leases in place, and ask them what their renewal rate is, and bring it on. All right. So, okay. Well, we got a bunch of questions in here, GC. I want to get into them, but I think since we don't usually get this chance to have a property on display, I would like to just go into what this IRR, this ROI represents when you are investing in a rental income property. Talk to me about the profit centers of a rental income property.
Yeah, absolutely. So I'll go back to this concept of us being financial engineers. I think that's really what we need to either be or we need to be becoming, right? We need to think about money as a tool that we need to put to work in the best risk-adjusted return capacity that we can find. How hard is my money working for me and what risk am I taking for it to work for that? And so when I look at the estimated conventional financing total return on investment here of 12%, and what you should take away from this is if you invest in this asset, your money should earn 12% on itself year over year over year over year. And that's a really great return on investment, right? There aren't a whole lot of returns on investment that you can earn in that similar capacity that you don't have to take outside risk to get. For example, in the stock market, consistently, you'll earn, over the long haul, you'll earn about 10% a year. That's what the data will show us. But you take a lot of risk during that time, right? You take a lot of risk of variability. Right now, the stock market, the S&P 500 is down a little over 20% for the year. So the risk that you take in the stock market, while you can still earn 10%, is that you have great variability. Sometimes it's way high, like the previous 2 years, it was way high. It was much higher than 10%. But then you also got to deal with what we're dealing with now, and that is inherent risk. So when I look at this, and what the way you all should look at this is you're able to earn 12% here in a risk mitigated fashion in an asset class that is much more consistent and much less variable. And that is a great segue to go into the 5 profit centers. But before I do that, anything that I should dive in there a little bit more?
No, I think you're good. I think risk mitigated sounds like a big floppy term for higher floor.
Yeah.
Right.
Yeah.
You feel the floor doesn't drop as much as possible is kind of what risk mitigated means. And then I think the other thing that you're saying is that, normally people associate higher floor with lower ceiling, but at the end of the day, when you are comparing long time in stocks, you're thinking that you'd be real pumped with a 9%. And this also happens to have 30% higher return than that.
Yeah.
So it's a high floor, high ceiling. Is kind of how I would describe it as the noble fool of the show.
And direct control too. So if we're comparing this to another competitor to this asset class, it's syndications. And in syndications, you generally will earn, call it somewhere around 12%, or that's what you'll at least sign up for. Those are typical offerings. But what you lack there is control. Here, you own the asset. In a syndication, you are part of a pool of investors who together you own the asset. And there's a manager, an operator who is the decision maker. You give up all of your ability to make decisions to that operator. So if you wanted to sell the property next week and you're in a syndication, you can't do that. If life came, you can't do that. The other thing to keep in mind is that the upside when you're in a syndication is limited, because that operator also typically gets 20% of the upside. Here, you have direct control and you have all of the upside, which is pretty cool.
Makes sense. All right. So, all right, tell us about the 5 profit centers.
Yeah, so the 5 profit centers. So this is, again, goes right into risk mitigation.
I'm going to just say, whoever puts the first 5 profit centers in the chat is my best friend.
Let's see if you can do it. See if you can do it before I get all 5.
Yeah, go.
These 5 profit centers give me confidence to invest in this asset class, even though I don't 100% know if and how big of a recession we're going into, or what may be down the pike as far as the war in Ukraine, or what COVID challenges we may see in China. These 5 profit centers, I'm not only banking on this paying me one time, I'm banking on it paying me 5 ways. And that's why I love this asset class. That's why I left my corporate job 17 years ago and really scared the hell out of my family and my parents and said, I'm going all into this asset class, not just to buy them, but to build a whole company based off of it. It's because of these 5 profit centers. Profit center number 1, net rental income, otherwise known as cash flow. When I talk about risk mitigation, this is the one that mitigates risk. This is the one where you've got this rental income coming in. You've got expenses that you know are going to happen, but the rental income is more than offsetting the rental expenses that happen on a monthly basis. And you're left with a little bit left over. And I don't get too, fired up about that amount left over. If that's $100 or $50 or $25, sure, I want it to be more than less. But the big thing for me is that I need it to pay for itself, right? I need it to pay for itself. So that's net rental income. Then you've got tax savings. How are we doing? Has anybody put them all in here?
Obviously, the MVP of the community put it in first. The question is, so we had Drew Barnhill put it in first.
Yeah.
And then, I'm sorry, Lee Bishop put it in first. And then Ringmaster Drew Barnhill came in right after. And Dean Curry came in right after that.
Yeah.
But Lee abbreviated home price appreciation as HPA.
Oh,
so
what an MVP move.
Savvy move by the MVP.
That's why he's the MVP. We'll talk about a killer lineup right there. You put a lineup right there. You put those starting 5 right there on the NBA on the court.
I'll take it.
Goodness, will we beat any other? This totally. We should have a Not Your Average Investor Show basketball team.
I would be the worst player on that. I'll continue.
All right, next we've got tax savings. So this asset class has these incredible tax advantages that you just don't get in other asset classes. You don't get it in the stock market, and you don't need to have some special criteria in order to get these tax advantages. There's a lot of tax advantages, but the one I like to focus on is called property depreciation. Depreciation. This doesn't mean that the value of your home is going down, market value. I'm just talking about depreciation from a tax perspective. And what the IRS allows you to do is to write off depreciation for your asset. Now, let's not get into too much of the accounting or the tax thing. Let me just keep it really simple here. At the end of the year, the money that you make generally gets taxed at your income tax bracket rate. The money that everybody loves write-offs because a write-off allows you to decrease that amount of taxes that you claim, right? It decreases the amount of dollars that you have to spend on the amount of money that you earn this year. Depreciation does that by a big, big margin, right? Sometimes it takes care of all the rental income that you earn and then some. You have some left over to give to other assets that are similar. Sometimes it just takes care of a portion, but whatever it is, it's giving you the ability to keep more of your money that you earn and pay less in taxes today. What you do is you're actually deferring it till the future, to a point when you would sell. And there is always inherent in value paying taxes later than there is paying taxes today when it comes to your return on investment. That's why people love IRAs and 401ks. That's what you're doing. You're earning money today and you're paying the taxes on it later, and people love it because you're return, your assets continue to grow unhindered by Uncle Sam. And so that's tax savings. Next, we've got principal pay down. I love this one too, man. Not enough people think about this, but like,
it's so good. I love this one.
Right. This is the like sneaky fun one, right? Have you ever out there, for all of you out there, have you ever said to yourself, man, you know what? I got this bill to pay. Like, I wish I could just like call up somebody in my family, or I wish I could just find somebody out there that would just like pay this bill for me, right? Like, how much better would my life be if I didn't have this student loan to pay, or I didn't have this, you name it, this bill, this loan to pay back, right? Like, wouldn't that be awesome if I could just make a call and then somebody would just pay that off? I mean, what if they would just literally pay it off every single month? What if I could put them on a payment plan? What if I put somebody else on a payment plan to pay off my loan? That's called rental property investing, right? What's happening is when you invest in an asset that is cash flow positive, part of your expenses every single month is the principal on your loan. And so when your resident is paying this off for you and taking care of that expense, and then you still have money left over, what that means is that they are on a payment plan to pay off your loan for you. And you're going to wake up in 5 years, 10 years, 20 years, maybe 30 years, depending on how long you keep that loan in place. And you're going to say that you're going to see, even if the home value didn't go up, the amount that you owe on that loan is going to drop drastically. And I can tell you this is amazing because I've been investing in rental properties for almost 17 years now. So I see it, I feel it. It's amazing. And it's a beautiful thing. So listen, we want to treat our residents really, really well, because we think that's the right way to treat people. And we want to do a positive thing for our residents. And that's why we do what we do. But there's a whole nother reason, just economically, like we want to treat them like gold because it's also going to help your returns on investment. And through principal pay down is one of the ways that people often overlook, but it's so sneaky fun. That's how I like to think about it.
All right. Was that 5?
That was 3. We've got home price appreciation. You ever heard of that one?
Yeah.
I feel like I'm wearing you out over there.
I've heard of HPA.
HPA.
I'm just having a blast in the chat, man. Like, I'm like, you're just going off. I'm like, talking to my friends.
It's cool. I'm talking to my friends out here. You just do your thing.
Yeah.
Right?
You talk with your mouth. I talk with my fingers.
Home price appreciation. So, obviously many people have heard and read about ridiculously high home price appreciation over the last 1 to 2 years here. It's been about 20% home price appreciation year over year in Jacksonville. I've never once seen it that high. I doubt that I'll ever see it that high again for a 1-year span. And there's a lot of reasons why that has happened. That's not normal. But what is normal is that home prices tend to appreciate at a very similar rate when you take it over a full market cycle. That's when we talk about the real estate cycle. If you have ever said that there is a real estate cycle, what you're saying is that you think that home prices are cyclical. Home prices come back to the norm if you give it long enough of a time period. And what the data shows is that if you look over a 10 to 20-year cycle for your market, home prices in your market or in Jacksonville will tend to repeat themselves. I actually have run this exercise with Madison. We've done this. And I said, Madison, give me any market here. We had 5 markets that are comparable cash flow markets. We had we had Memphis, Birmingham, Kansas City, Dallas, and Cleveland. And I said, give me any market here and give me 20 years. And I will tell you within 1% of what their home price appreciation rate is. And she said this, and I said this, and guess what? I was within 1%, right? And the reason that I know that and can deliver that with confidence is because I know how cycles work. The reason this should matter for you is if you know what your historically accurate home price appreciation rate is in your market, then you can use this information to your advantage to make the best decision to get the best return on investment, assuming you're going to buy and hold these assets for a full market cycle. So you got to be in for buy and hold for 10 to 20 years. Right? That's how this asset class works. That's when you should be counting on home price appreciation. If you're in this for a year, 2 years, 3 years, don't count on home price appreciation because that's not how it works. It can go up, it can go down, but most of the time it goes up a little bit to a lot, and I just can't count on it in the short run. So if we take this to the property evaluation, you can see that 4.6% appreciation rate, thank you, Pablo, that is the historically accurate home price appreciation rate since 1982. And that's why we use that here on your evaluation for your property.
I feel like it is the moment to lately what we've been doing is having guest investors on and you break down their portfolio. And as you see this stuff kind of like play out over time, you then show this like pie graph of like returns, right?
Mhm.
So I think it's significant to say that the majority of your return, when you look at the pie of the overall profit centers that you have, comes from that home price appreciation piece. And that's why you're so hot on Jacksonville. The fact that Jacksonville is out of the cash flow markets, the place that has the best home price appreciation, ergo for the buy and hold investor. That's why it's such a no-brainer.
I do. I think this is the best market to be in, and I'm absolutely biased, but the data also shows me that, because I look at the other markets where you can get positive cash flow and still be in below middle income neighborhoods, and their home price appreciation rates are 24% below what Jacksonville's has been since 1982. 24% below, right? So that's a very big, that equates into hundreds of thousands of dollars for your portfolio if you were to invest in another market where you got some positive cash flow, but you didn't get the type of growth that you get in Jacksonville. And imagine if you have 10 properties or 22 properties like Zach does, and he chose to invest in a neighborhood or in an area that was a slow growth or no growth market, right? He would be giving up millions of dollars over the course of the next 10 years to 20 years that he will capture. Assuming history repeats itself here in Jacksonville, he will capture that just simply by investing in the right market.
Yep, makes sense. And last one?
Last one's inflation hedging. Another one that's getting a lot of run here lately, which I love. I mean, I feel like we talked about inflation hedging for a long time and nobody wanted to pay attention to anything regarding inflation. Now is the time, I think, for us as financial engineers to really understand, this concept here. And inflation hedging is so critical. This is one of the big reasons why Wall Street is investing hundreds of billions of dollars in this asset class right now, right? Even though, right, home sales and home pricing will slow down, the gains will slow down. They need to slow down. Wall Street is doing more right now. They're buying more land. They're partnering with more builders to go bigger into buying and holding single family rental properties. And it's because no matter what home prices do next year or 2 years from now, the fact that this is an incredible hedge against inflation does not change. And here's what I mean by that. When you invest in a rental property, the same components that go into what it costs to build a property they're not going to change between now and a year or 2 or 3 or 4 years from now, right? It's the same components. And as inflation happens, the cost to reproduce this asset will go up, right? As the cost of these goods and services tends to go up with inflation, the price to reproduce housing goes up. And so what that means is cost over the long haul, both rent prices and home prices tend to go up, because in order for anybody to want to build a house in 5 years, the cost to build that house are going to be higher than what they are today. And if that builder wants to make the same type of profit margin, then they are going to need to sell that house at a higher price than what they are selling that house out or renting that house out today. So that's what we mean by inflation hedging, right? If you believe that builders are still going to want to make a profit in the future, and you believe that costs are going to go up in future years, and you think that they're going to sell new construction houses, then those costs of those new construction houses over time will be higher than what it is right now. So when you buy into a rental property, it's a hard asset. The cost, meaning the inflationary pressures, push that up. For you, that means that home prices and home rents tend to go up with inflation over the long haul. And that's a really wonderful thing, because right now in the stock market, inflation is raging and stock values are plummeting, right? That is not a hedge against inflation just by itself, owning a paper asset like that. So that is at the core of why savvy investors love rental properties. One more thing to add here. If you use smart debt, you are like inflation hedging and inflation profiting on steroids here, because a different component here is if you lock in your debt today, like Pablo, how cool would it be, right? Like cost of milk right now is just a lot, right? Well, let's talk about gas. Everybody talks about gas, right?
Yeah.
Cost of gas today is a lot higher than what it was back in the day, right?
Fact.
Yeah. Cost of gas is a component of building or serving or whatever. It's a cost of business for a lot of businesses,
Correct.
right?
That's a cost of business of getting to work.
Business of getting to work, right? Personal for sure.
Yeah.
But let's just keep it from a business component, because that's what investing in a rental property is. How cool would it be if you could go to one of your cost inputs of business and you could just be like, listen, I'm just keeping that fixed. I don't care what happens in the economy.
Yeah.
Like, I'm just keeping this fixed.
Yeah.
Let's call that it was gas prices, right? Let's just say that, you know what? You had the ability to just lock in gas prices, and then you could just run your business, not having a fear of that, of whether gas prices would rise. Would you love that?
Yeah, I would love that. Man. I would love that.
You would, absolutely. We would all love that. Well, that's the concept that you get when you take out smart debt on a rental property, because what you're doing is one of your biggest costs of owning this rental property on a monthly basis is your interest cost, right? It's your interest, especially in the beginning of the loan, right? Let's take your overall payment, but overall, especially in the beginning of a loan, it's mostly interest. And you're able to say, listen, I don't care how much costs rise on all of this stuff for the next 3 years, 5 years, 10 years, 20 years. I know it's going to happen, but I know one thing that's not rising: my payment every single month.
Yep.
My interest that I pay every single month is the same, or actually will go down the longer that I hold it. And there's just incredible value there, because in inflationary times, the other part of inflation is that we all tend to bring home more income as well. We don't necessarily get to buy more stuff because the costs also go up, but we get to bring more income home. That's right. That's why, 50 years ago, like making $100,000 meant a lot more than making $100,000 does today. And 50 years from now, it will mean a lot less, right? So we tend to bring home more money. Well, if you combine the fact that you're locking in your interest payment, you're locking in that cost input, with the fact that just simply being in our economy means you're going to bring more money home in the future, you're going to be able to pay that loan down more easily in the future. And that's called inflation profiting. And that is why those two combinations are why Wall Street absolutely loves this asset class and is bringing hundreds of billions of dollars here.
I feel like I just watched your TED Talk. That was awesome, dude. That was awesome.
Love that.
Summing it up, cash flow, right? Like making more money more money coming in than you are doling out on a month-to-month basis. Entry to the game. Principal pay down.
Sure.
What Tim Hicks calls worst comes to worst, you got a resident in there that is paying down a loan that you took out.
Mm-hmm.
Tax savings locked in, right? The idea that having this thing, you can depreciate the cost of the actual building itself, not the property. That creates a positive cash flow taxing event kind of thing, right?
It's you keep more of the money that you earned.
You keep more of the money that you earned. Home price appreciation, the biggest piece of the pie, the reason why people like to invest in Jacksonville. I think we all understand that one. The key thing to understand is if you're in it for a long time, you can bank on it.
Yep.
Right. And then inflation hedging, something that everybody's worried about right now. Inflation, the ability to lock in the value of something lock in your inputs when all your costs around you are going up and keep your profitability there.
And the fact that your rents and your home prices will tend to go up with inflation over the long haul.
Good stuff. We had some really notable comments in the chat. I'm gonna call out two.
Okay.
One is Bob Wiesner with a wonderful, wonderful compliment. He said, I'm just gonna say it because I'm self-indulgent right now. But he put 5 profit centers: Sefakis, Cohen, Eisman, Regal, and ... Pablo.
That's awesome, Bob. Thank you, man.
By the way, I completely, it's Sefakis, Cohen, Eisman, Regal, and the JWB team that actually does all this stuff. I just get to report on it, man. I just get to take the credit. But the JWB team is what you guys always talk about as your number one.
There's your outsized growth right there.
It's your people. And then Hervé also has another hot take. He says, I'm officially announcing a 6th profit center. Investing with JWB gives you peace of mind. POM. To me, especially in this crazy market, it's a profit in itself.
Thank you. Thank you, Hervé. That's what, man, at the end of the day, that's what we're here to create. It's a wonderful experience so that you feel really confident about where you're putting this money.
Love it. Love it. All right, man, let's do some rapid fire. Some of these questions. Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
Home of the manatees. She asks, how quickly are homes renting out in this market right now?
Hotcakes.
Hotcakes.
Like hotcakes. I was actually just checking the numbers. Would you believe that we have over 1,300 people that request to see a rental home for us just last week?
Wow.
1,300 people last week.
I mean, I'm not surprised. Home prices are super high.
Mhm.
Mortgage rates are even higher, right? Like, so it drives rental demand.
Yeah.
That is one of the reasons why this asset class is good.
I think that might be the most we've ever had in a week,
Yeah.
right? Typically, I'd say we're right about 1,000. That's 1,000 new people every single week that are filling out a lot of information to go and see a home. We had 772 home showings attended last week.
Mhm.
And when you go through all of that and the qualifications and all that good stuff, we're renting out about 30, 35 homes a week. So call that, what's that? 100, 110, 120-ish homes a month.
Yeah.
It is going very, very well. And I don't see an end in sight. So super proud of the rental homes team.
Cool. I call that hotcakes. All right. And that to me means basically in that term, that to me is risk mitigation, right?
Mhm.
It's like the idea, like the worst part of rental properties is when you have a turn, the shorter that stays open,
Mhm.
the more money you make,
Mhm.
right? So like it's risk mitigation. All right. Marilyn Connerman from Homosassa, Florida
Home of the manatee.
also asks, have you seen more 2 or 3 year leases during this difficult housing time period?
It's been right about what we have done consistently. I think when we reported on the Jack's market update, I think it was about 26%, or it was about 26 months was our average duration of lease signed for the initial lease. It's really been right around there, 26, 27 months for the last few years, if I can remember. So no real noticeable change.
Okay. Hervé Francois, the pride of New Jersey, asks, in setting the sales price, do you typically set the price right in line with the average of area comps, below or higher? If below, how much lower? Thank you.
Great question, Hervé. We set it right at market value, which would be right in line with what other things are selling for in that area.
Cool. Leo Baraganan.
Dun, dun, na, na, na.
Baraganan.
Dun,
He,
dun, na, na.
he asks, how is the rental market in Jacksonville now? What is the average days at the home stays vacant after tenant leaves or new home for rental?
I don't have the stats right on me. I'll make sure I have them, especially for our next Jacksonville market update. But I know things are really firing on the rent. Yeah, hotcakes from the previous question there. Generally it's taking, call it about, 20, 30 days for the home to be leased out. And you're looking at, call it roughly 30 days to move in. So anywhere around 60 days from market to move in is incredibly strong. And I'm sure we're there right below it.
Lee Bishop has a rare question for me. He says, Pablo, can you talk about this house being septic and the maintenance rate is only showing 4% to justify main being low talk? All right, I'm just assuming that's all right. Talk about the JWB ingenuity by coming up with the insurance program to help the investors. All right, so he's talking about, I'm going to share this again. I don't think it really was a question for me. I think he just wanted to get my attention, so I ask it, which I like to do. So he talked about how the fact that this is a septic tank home and the maintenance rate is only 4%.
Mm-hmm.
What is there to learn from that?
Well, so when we're talking about the septic warranty program, that is mainly working with, homes, new construction homes or renovations that we have put a brand new septic tank in. And what we're doing is reducing the maintenance costs. The reason you're seeing me stumble on this a little bit is because that actually has no bearing on what new construction septic homes have. So, if you go back over the years, even before we put the septic warranty program in place, the expected maintenance costs for septic properties that are new construction still was 4%, because that's what the data has shown us. So actually the septic warranty program on brand new construction homes like this actually hasn't actually shown a decrease in the maintenance cost. It has been 4% even before we had the septic warranty program here. So probably a little bit more in depth than you were asking, Lee, but we're going to be talking about the septic warranty program here. There's a few things that I want to share with you guys probably over the coming weeks that we're working on internally here, and might be something to pay attention to. A little teaser there.
Twinkle in Jesus' eye.
So we're going to take a little bit more of a deeper dive on that. But for this property, actually would have no bearing. This was 4% as far as maintenance for septic properties or for sewer properties before. And so this wouldn't really change much.
Okay, there you go. Good question, Lee. And GC, it made the outside edges of GC's mouth do something very interesting there. So I'm looking forward to this. All right, here we go. Gerard Wendling with our last question of the day. Thank you for the question. Gerard says, hello, gentlemen. With rents going up at an accelerated rate along with sales prices, how are you controlling rents to where they are not affordable to our target market? And what percentage has rent increased the last couple of years for JWB managed properties?
All right, keep that up. I just wanted to make sure I saw all those questions here. So first part of this, so rents are going up at an accelerated rate, and so are sales prices. How are we controlling rents to where they are not affordable to our target market. You know, rents are going up and home prices are going up. I mean, there's not a whole lot that we can do to make sure that we can control rents, right? That would be us renting them out for a lower amount than what we could provide as far as returns on investment for you. And even if we wanted to do that, that really wouldn't be possible because, you know, at the end of the day, we make acquisitions decisions. One factor of the acquisition decision, what we are buying that will eventually become a turnkey rental property for you, is based on what rent we're able to achieve. And if we were just saying, hey, listen, we want to keep this affordable for residents out there, that would lower our rent number. That would make the price that we could pay for the asset much lower. And we wouldn't buy any houses. We wouldn't buy any land, right? So in order for this model to work, it has to be built off of renting at market rate, market rent for everybody to win here. And then, you know, we control about 5% of the housing stock in Jacksonville in terms of JWB property management. We manage about 4,500 homes. There's about 82,000 single family homes in Jacksonville. So, you know, even if we wanted to control rents, it wouldn't work from a model perspective, and we couldn't do it because, you know, we don't control, we control 5% of it. But I think your bigger question is what should we be concerned about with affordability in the future? Is affordability a concern? Right? Affordability should be on the minds of everybody going forward, right? If housing becomes unaffordable, right, people won't be able to buy that. They also won't be able to rent it. A couple of things to keep in mind though. You know, the shock of interest rates going up has really affected especially first-time home buyers, but those who are buying houses. You know, it has taken that mortgage payment. I don't know what it is. You can read articles out there, but the payment has increased, what, 30% or 40% or 50%, really just in the span of about 6 months. And that really affects those who are buying houses. That makes it much more unaffordable. Mm-hmm. When that happens, people still need a place to go. They still need shelter. That is going to push more towards rental demand. You are going to see more and more renters coming here. The percentage of renters is going to be higher, especially when home prices and affordability. So that's a good thing for us to have renter demand, right? Those renters seemingly would be those that can afford higher rents as well, because they would be more credit worthy. They would have been buyers if interest rates would have been lower. So you have that working for yourself. But big picture here is, in order for you to win, Gerard, you need to be investing with a provider and in a market where incomes are rising. Incomes rise, and Jacksonville actually has had one of the highest income raises over the last year and a half. I think it was 12% when in the Business Journal article that I read, which was one of the highest in the nation. Yeah. So that's one of the ways that people are affording to pay higher rents. Incomes have risen over the last year and a half. But beyond that, you need to work with a provider that is so focused on this market that actually cares about doing the things that raise median incomes. Can you think about anything that JWB is doing that might have an impact on raising median incomes?
Somebody has said something along the lines of developing the urban core and attracting Fortune 500 companies.
Yeah. What do you think about, you know, buying 19 city blocks in downtown and raising, you know, hundreds of millions of dollars to, you know, put into downtown Jacksonville?
I've heard of this. I've heard of this venture by JWB.
Yeah. That's why we're doing this, right? We are doing this because this is the greatest opportunity for us to have your rental properties around here see higher rents and higher prices in the future. Because when you invest heavily in downtown, you're able to attract more people living downtown. More people living downtown attracts greater amenities downtown, businesses, bars, restaurants, things that people like to do. That also attracts talent, that attracts employers to want to be downtown. And all of this stuff comes together, and raising median incomes is one of the outputs of all of this. And when that happens, we're able to see higher home prices and higher rents that people can afford because they have the income to do that. All of that wrapped up is why you should invest with JWB. Because listen, it's not about the property. It's not even about the neighborhood that I put you in. It's the fact that when you invest with JWB, we outperform the market for our investors, meaning the Jacksonville market here, right? 79% more home price appreciation for our clients in our neighborhood since 2013. And that's because of the JWB effect. And so I look at the downtown investment as a big opportunity for us to help with the affordability challenge that we don't have so much right now in Jacksonville, not nearly as much as other places, but will have. Yep. And that's the greatest opportunity we have to continue outperforming Jacksonville's average home price appreciation rate for the next 10 years, 20 years, 30 years.
Good stuff, buddy. Last little follow-up here by Denny Davis. He says, follow up to that one. Any concern that in the advanced nature of rents will lead to more evictions in the short term?
I don't have any concern of that because our requirements for renting a home with us continue to get harder and harder. You know, one of the requirements is that you have to make 3 times the monthly rent in order to be considered for renting one of our homes. And so as the rents continue to go up, the requirements for how much you have to earn continue to go up. And there's a lot of other requirements and qualifications as well. But no, I don't have any concern with that.
We did it, buddy. POT dubs.
Love it. Way to
Good
go.
one. Listen, if you took an hour of your day to hang out with us just now, I just want to say I really, really appreciate you. We don't take that for granted, right? Wendy, welcome to the show. Anybody else that was new that didn't check in the chat, we'd love to have you here. We'd love to have you returning. We really have this like community. If you want to hang out with us in between, you know, now till then, go to the Facebook group. If you put a Not Your Average Investor Show community in Facebook, yeah, there's a Facebook group in there. You can find it. It's not that hard. If you were listening on the podcast, watching on YouTube, go to nyais.com, be part of this. I think it's magical. Really, really great questions from the community. You crushed it today. I really enjoyed the ability to just go deep into a rental property and talk about the 5 profit centers. I haven't gotten to listen to the GC
Awesome.
TED Talk in a while, man. It was a good one, buddy.
I love this platform. I love you guys giving us this platform. Thank you so much for taking the time to be here. I'm seeing the chats right now, and we're giving an open invitation for all the lurkers out there, those who are in the chat to, you know, reach out, say hi, become a part of this network here. It's something so special. And we love you guys.
That's right. I see you, David Singhi, lurking along, buddy. I want to be your friend. Next week, Tuesday, part 2 of how to invest in and come out on top in a recession, where we are telling the story of how JWB built their rental income portfolio. Part 1, we talked about 2006 when it started, right before, you know, when the market was super hot and the recession was looming. Sound familiar? Yes.
Mm-hmm.
This part 2 is going to be right after, right? Like what happens years 5 through 10
Mm-hmm.
of like what things start to open up, how properties perform once the economy starts bouncing back. It is something you're going to want to listen to, and I hope to see you there. And from now till then, do not be an average investor.
See you.